Hi there. When it comes to getting a mortgage and making those payments, there are a lot of unfamiliar words you might hear, like forkerdon, clam crash, moodle. I'm just kidding, those aren't real words, but one that you might continue to hear is escrow. Well, I'm here to take the mystery out of escrow so you have more clarity about the hard-earned money you pay each month. Let's start with your monthly mortgage payment. Regardless of whether it's a fixed or variable rate, it's broken down into two parts, the principal and interest part and the escrow part. Most of us know what principal and interest is, but many of us aren't clear on what makes up the escrow portion of the monthly payment. Allow me to explain. An escrow account is simply an account used to pay your property tax and homeowner's insurance with funds from your monthly payment so that you don't have to keep up with those bills. We do it for you. Isn't that nice? I mean, that's one less thing to have to worry about, right? It's like a peace of mind account. Now, let me explain how this is all calculated. Let's assume I have a fixed rate mortgage, so the principal and interest portion of the payment will stay the same each month. In the same way, the tax and insurance portion of your payment generally doesn't change very often either because the escrow account is only analyzed once per year, even though your actual tax and insurance bills are going to sometimes go up and down. As you can probably guess, we don't have a time machine, which begs the question, every year when we analyze your account, how do we calculate what next year's escrow payment will be? We estimate it based on your tax and insurance payments from the previous 12 months. If it's a new mortgage, it's based on the previous amounts given at your loan closing. So, based on last year, we find the month with the lowest projected balance. If that month's balance is below the minimum reserve, that's considered a shortage, and you'll owe more money to make up the difference. If it's higher, you get a surplus refund. It's like a tax refund, but better because it's not taxes. Speaking of taxes, here's an example of what I'm talking about. Let's say your taxes go up in the middle of the year. Your escrow account will automatically pay for that increase even if there's not enough money in that account, so you don't have to worry about catching it. Even though taxes went up, you kept paying the same amount. That also means that your account balance will be lower than expected at the beginning of the next 12 months. Therefore, you'll start paying a higher amount to cover that tax increase. If you're like me, you like options. At SWBC, we give you multiple ways you can pay this shortage. You can pay all of it. You can pay part of it now and spread the rest across 12 months, or you can pay as little as you want right now and then spread the rest across 12 months. Please keep in mind that even if I pay all of the shortage now, my monthly escrow payment would still go up to cover the higher taxes. The lowest my monthly escrow payment can ever be is 1/12 of my tax and insurance bills. See? Now, wasn't that easy? SWBC Mortgage is here to help, and if you have any questions, feel free to reach out to our customer service folks. Thanks so much.